Have you ever asked yourself, what investment can make me rich? Unfortunately, the answer is it depends. There are so many different things out there that you can invest in. A lot of them can make you rich, but then a lot of them can also make you poor. This video will tell you about all of the different things that you can invest in, how likely they are to make you money, and a step-by-step plan on how anyone can get rich. Hi, I'm Evan, and let's talk about asset classes. These are essentially groupings of different things that you can invest in. The most common asset classes are cash, fixed income, commodities, real estate, and equity. Some people might also use an alternative investments class to include things like cryptocurrency, but I'm going to throw those in commodities. Let's start out with cash assets. Cash assets are primarily used for short-term investing. Cash assets are not just simply cash, but they also include things called cash equivalents. These are things that are highly liquid, with liquidity being a measure of how quickly things can be exchanged or traded for cash. Obviously, cash is the most liquid asset out there since you can buy basically anything with regular money. We call this physical currency, bills and coins, hard money. Hard money is not an investment that will make you rich. If your money is just sitting around, it's not growing, and so you're not making any more of it. In fact, money that's just sitting around is actually losing you money over time due to inflation. This is the decrease in money's purchasing power over time. The same dollars of today won't be able to buy as much stuff in the future. So holding on to hard money as an investment will actually make you poor as you lose purchasing power over time. What hard money and other cash assets are good for are their liquidity. You need some liquid assets in order to cover your emergency fund and to have access to money in case you'd like to buy another asset. Another example of a cash asset is your savings account. These generally give you really low interest rates for your money, so you're going to run into the same problem as with hard money. The same will be true of certificates of deposit, which are basically just savings accounts that give you a slightly higher interest rate for locking up your money for a given period of time. The last cash asset that you might consider are money market accounts. These are essentially high-yield savings accounts, but with less restrictions. This means that you won't be restricted on withdrawing your money like you would be with a normal savings account. Money market accounts can be a good alternative to your normal checkings account because most banks don't offer an interest rate on your checkings. But of course, even the money market won't make you rich. To find an option that might, let's look at another asset class, fixed income. This category is basically just bonds and a lot of things that are very similar to them. For bonds that last 1 year or less, particularly government T-bills, we should technically categorize these as cash assets. But it's going to be easier if we just talk about bonds altogether. Bonds have a face value, typically $1,000, and they sell for above or below this value depending on market conditions. They last for a certain time called the bond's maturity. Along the way, they pay out periodic interest payments normally every 3 or 6 months. These are called coupon payments and they are shown as a percentage of the bond's face value. So a 10% coupon bond would pay you $100 every year. At maturity, the bond pays out one last set of coupon payments and the full face value of the bond. So in this example, you would make $1,100 in the bond's last year. Bonds are very popular as a means of generating income, particularly passive income. They pay you interest payments on a set schedule and you can determine how much these are going to be based on the coupon rate. The issue is that investments that focus on paying out cash tend not to grow as quickly as investments that are focused on growing in value, otherwise called capital appreciation. The bond market will make you about 5% a year on average. This assumes you're able to reinvest your periodic interest payments at the same coupon interest rate. The average 5% annual return is higher than the 2 to 3% average annual inflation. This means that your money will see real growth. Real is the word for adjusting your returns based on inflation. Because we're seeing real gains, that means that bonds can make us rich. The issue, of course, is that the interest rate just isn't super high. Let's talk about how this affects your ability to get rich. Getting rich is actually pretty simple. It's a function of time and money. The time value of money states that money today is worth more than money tomorrow. This is in part due to inflation, but also because money invested today will be able to grow faster and into a larger amount of money than money invested tomorrow. This is thanks to the wonders of compound interest. The time value of money also means that the larger the initial investment and the more time that your money has to grow, the more money that this will be worth compared to lower initial investments or money invested for less time. The math behind this is demonstrated in the future value equation. Now don't worry, we're not actually going to do any math, but importantly, this equation actually consists of 3 things. Time, money, and R, the rate of return. The higher the rate of return, the quicker this growth will be, and the sooner it will become exponential. So going back to bonds, 5% just isn't a lot in comparison to other investments. As we'll talk about later, the stock market has an average annual yield of 8 to 10%. So money invested in the stock market will grow quicker than money invested in the bond market on average. The difference in these returns comes from the risk-reward or risk-return relationship. This says that investors should see an increased return for assuming more risk. Since stocks are riskier than bonds, stocks give you a higher return. And higher rates of return are what we need to get richer sooner, so let's look at another asset class, commodities. Commodities are physical goods that have some sort of value. These include things like gold, art, and even wheat. Commodities are interesting in that some of them are valuable things which don't normally trade on public stock markets, such as comic books. The issue with tangible goods is that you have to store them. Imagine dealing with literal barrels of oil. Instead, popular commodities like gold, silver, and oil trade on the stock market through exchange-traded funds or ETFs. These are investments that track the value of something else, most popularly the S&P 500 stock market index. So ETFs allow you to invest in something like oil by tracking the value of it without making you store the physical commodity. You can even get in on wheat ETFs or cattle futures. Don't actually do that though. The issue is that commodities are highly speculative. As we're seeing right now with all the supply chain shortages, who knows what's going to happen to commodities in the short term. Oil has been up and down, as has aluminum. Collectibles generally increase in price over time, but only so long as there's continued interest in the brand. Even the most popular commodity, gold, basically traded sideways from 1980 to 2005. Commodities are highly risky, so they do have the potential of making you rich. However, they don't give you the same easily projectable returns as other investments. So that makes it tough to determine your average annual rate of return and how quickly you can become rich. They also have much more potential to see you lose your entire investment into them. And speaking of highly risky speculative assets, let's talk about crypto. Crypto is a commodity in the same way that art is. It's used a lot for money laundering. I kid, but it's mostly because its value is determined by speculative supply and demand rather than practical use as the value of aluminum is. Crypto has extremely volatile returns, so again, it's tough to predict what your annual returns are going to be. In the past, I have suggested using crypto lending platforms and stablecoins as a means of generating a less volatile, guaranteed rate of return within crypto. These platforms have started to remove these passive income options from US users. Commodities and cryptocurrency especially should only represent small fractions of your portfolio, given their high volatility. They should really only be seen as a means to diversify. A very popular way to diversify is through real estate, our next asset class. Real estate is generally broken down into physical property and then REITs. Of course, investing in actual real estate is pretty tough. It takes a lot of work to find good deals and to be a landlord if you want to start generating cash on your rental properties. Securing a good, low interest rate mortgage also requires you to have a good credit score. Plus, home prices are pretty out of control right now and the Fed is only increasing interest rates. All that is to say, real estate investing is tough, but it does have its benefits. Beyond being great for diversification, real estate is generally seen as a strong store of wealth in tough economic conditions. Plus, if you don't want to get into physical real estate, you can just buy REITs like you would any other stock. REITs, or real estate investment trusts, are companies that own and operate physical properties for other investors. They must pay out at least 90% of their taxable income as dividends every year. This means that you can rake in some good returns while also diversifying your portfolio. In fact, some REITs actually boast returns fairly close to or even in excess of the overall stock market. So REITs will probably make you rich. One factor to consider is that many REITs are focused on cash payouts. So these high returns include compounding reinvestment like we saw with bonds. In general though, reinvestment is obviously going to net you higher returns in comparison to not doing so because of the time value of money. You're putting in more money sooner. This can also be seen in the stock market, which takes us to our last major asset class, equity. Equity primarily consists of stocks and things that are similar to them, such as ETFs and mutual funds. Equity is simply a piece of ownership in something else. The simplest way to invest in stocks is to get into mutual funds and ETFs. They can give you a lot of diversity by letting you buy into a bunch of different companies with just one investment. Now, I'm not going to bury the lead. If you want to get rich, you're going to have to get into stocks. The easiest way to do this is going to be to buy an index which tracks the performance of the S&P 500. This basically just means that you're buying a single investment which should match the rate of return for the top companies in the US stock market. As we talked about earlier, this is about 8 to 10% a year. That nets you 5 to 8% a year in real gains after adjusting for inflation. So now that we know about equity and a bunch of other asset classes, how can we use this knowledge to get us rich? It's simple. We're going to follow the time value of money. First, you'll want to invest as early as possible. Investing as soon as you can gives your money more time to grow, and so you'll have more money more quickly. The difference between investing $100 a week at 8% a year at age 20 versus age 25 is nearly $1.2 million by the time you're 70 and retired. That's a huge difference. And due to compound interest, that $1.2 million will also be snowballing into even more money every single year. Second, invest often. One of the best things you can do is to invest on a set it and forget it schedule. This makes your money go to work for you without much effort. I invest weekly, but you can choose bi-weekly, monthly, or whatever works for you. Consistency is key because it helps you dollar cost average into the market. Third, utilize your tax-advantaged accounts. I've talked about these a whole bunch, so I'll skip over some of the details. Just know that you can currently invest $30,150 between the 3 different tax-advantaged accounts: the 401k, IRA, and HSA. These will save you money by giving you special tax benefits, so you'll be able to make and keep more money over time. Fourth, you have to hold long term. It can be tough psychologically to see your investments decreasing. Unfortunately, this is just natural in how the market always operates. The best thing to do is to just keep your money invested so that you don't miss out on the best daily gains. Missing these can severely hurt your lifetime gains, so just buy the market and hold rather than trying to beat the market. One of the benefits of tax-advantaged accounts that's not talked about enough is that they make it easier for you to hold long term. You're penalized for pulling your gains or sometimes your contributions early, so you have to hold long term in order to realize your tax benefits. Fifth, diversify. As we've talked about, there are a lot of asset classes. Don't just go all in on stocks stocks and don't just go all in on the S&P 500. For example, investing a small portion of your portfolio into bonds should actually increase your yearly returns while decreasing your volatility, since bonds tend to do better when stocks are dipping. With that, make sure to dip your mouse onto that like button to increase this video's returns in the YouTube algorithm. It really means a lot to me, it's free, and it helps others discover this super valuable content which can make you a bunch of money. Subscribe and ring the bell if you would like to be notified when new videos come out every Friday. Let me know what I can do to make these videos better and comment down below. Click that video on screen to watch another that you're going to enjoy. Thank you very much for watching, and then please add some music, some investments that will make you rich, or whatever else it is that you love to your day.